Good Saturday morning to you, everybody, and welcome to Mortgage Matters with Rob Weinberg. I'm Gary Byron. Glad to have you on board. Rob, how are you, buddy?
I'm doing amazing.
Good morning. Amazing. Wow. Boy, I don't hear that every day. Yeah, I usually hear good, fine, everything's great, Amazing. Well, tell me before I even get into anything here, tell me your secret.
It's just, as we'll be talking about, it's a great time to be in the real estate market. It's a great time to be getting mortgages. It's a great time to be getting your finances in order. Maybe contrary to the news and the media.
Yeah,
but
well, can't listen to that,
Exactly, but it's amazing time, and I'm just blessed to be able to help people and do this every day, and the opportunities are just more than I've ever seen, again, as we'll be discussing.
What a breath of fresh air. I feel the same way about what I do. But, that's when you love what you do, it's barely even work at all,
Agreed.
Well, speaking of which, I had a question for you. What exactly is cash out refinancing, and why is this approach any better or more effective than, I don't know, just like taking out a personal loan from a bank?
Yeah, cash out refinancing is really one of the best options right now for homeowners.
Okay.
And actually, before we even touch on that, what I want to say is that if somebody doesn't own a home yet, or they're aspiring to own a home, there's still a lot of value that they can get from knowing about cash out refinancing, as we're going to be discussing.
Okay.
Because it's something that a lot of people don't understand, they don't realize, and maybe they haven't been educated about, which is what we're here to do. So what a cash out refinance is all about is it's about releasing equity out of your home. Equity is in the walls of your house, and there's really only two ways to get access to it, which is either sell your house, meaning you can't live there anymore.
Or take a home equity loan.
Or exactly, take a home equity loan, a mortgage, a line of credit, that sort of thing. So cash out refinancing refers to paying off your current mortgage and replacing it with a new mortgage that's bigger, and you get the difference. So it's a very good strategy. And again, a lot of homeowners and new people that just bought their house, they don't even know this exists. They don't even know it's available. I will say that usually if you just bought a house, it's not going to be an opportunity.
No.
But once you've owned your house a couple years, once you've seen appreciation where it's gone up, there's huge advantages to using this over the personal loan, like you said.
So you're taking the equity and cashing it out.
Yeah, not necessarily all the equity. I mean, there's limitations, as we'll discuss, but it's taking a portion of the equity out of your home. I've seen as little as, $5,000 all the way up to multiple hundreds of thousands of dollars.
To do what with?
You can use it for any reason. I would say the most common is to consolidate debt. That's probably the number one reason that people take equity out of their home. Another huge reason is to improve their home. So to do an addition, to redo the kitchen, to renovate, rehabilitate, that sort of thing. And the last thing would be investments, business opportunities. I have a lot of real estate investors that use cash out refinancing as a way to build their portfolio. They'll buy one property, they'll improve it, they'll add value to it, then we'll refinance it, we'll take equity out, we'll go buy another property, they'll do the same thing. Then they do it again and again. I have one client in particular that's done it 10 times.
Holy
just in
cow.
the last few years, and he's doubled his portfolio from 10 to 20 properties.
You talk about making improvements to the property that you purchase. Can you, let's say someone's going to buy a house, I don't know, $250,000. So they get qualified for a mortgage they're going to put, I don't know, $20,000 down. So they mortgage $230,000. But they want a pool, let's say, that doesn't exist. So they want to put it in. Is it better, or can you even do this? And if so, is it better to get the pricing of an in-ground pool? Let's say that's $20,000. Okay. So can they add that to their mortgage, or does that have to come under a separate loan outside of the mortgage?
There is a program, it's a rehabilitation or rehab loan that will do what you're talking about. That's not what we're talking about.
No, I know that, but it was a question that I had. Just within the last, I don't know, few days. And I'm like, well, I knew I was talking to you
Yeah,
today,
but again, in order to do it the way you talked about, where someone just bought a house and they put that money down, in order to borrow those high loan to value, as we call it in the industry, it would be a rehabilitation loan. Typically, with a cash out refinance, you're going to need to have at least 20% equity in the home.
Oh, I was going to ask.
That's typically, that's why, like I said a minute ago, it's going to be a scenario where you've been in the house for a couple years, or you put a large down payment, like 30, 50, 70% down, huge down payment, and then you can immediately do it. But I have clients, as we'll talk about, that bought a house a year ago, 2 years ago, put down 3%, 5%, a small down payment. But now, due to the real estate market increasing, they have enough equity. They have over 20% equity now, just in a couple of years. And now they can use that to actually liquidate and use for these other things. And I'm going to give you some stories just that I've worked in the last 6 months of people that have done this, because I know it sounds crazy and it sounds like that's too good to be true, but it's not. It's real. And the opportunities right now today, better than it was a year, 2 years ago, because of the real estate market, like we've talked about in previous shows.
All right, that's every time I sit down with you and we do this, I'm learning all these different things. Is there a limit, though, to how much that you can borrow using a cash out refinance?
There's really no limit. And that's one of the big differentials, to go back to your first question about why would you do this and not get a personal loan. Yeah. A personal loan, typically, number one, it's going to be a higher interest rate, anywhere from 6 to 10 to 15% on a personal loan, because it's not secured by anything. The minute you secure that loan by real estate, now you get those preferred mortgage rates. Now you get that preferential potential tax treatment depending on your circumstance. So that's one of the big reasons why people use a cash out refinance instead of a personal loan, is because you're typically capped on a personal loan at $25,000, $35,000, maybe if you're lucky, $50,000. But on a cash out refinance, you can borrow hundreds of thousands of dollars. I've never seen a scenario where an underwriter will go, oh no, they're borrowing too much specifically from a dollar amount figure. Okay, so I've had clients liquidate $200,000, $300,000. I actually had one last year. I think he liquidated $345,000 out of a house. He had no mortgage on it. We went and put a mortgage on it, and he took that money and he bought 3 other houses.
Oh my goodness! He put a mortgage on a house that had no mortgage, but that's not a home equity loan.
That is considered a home equity loan.
Oh, okay.
Yes.
You had me confused. I'm like,
the difference is with refinancing, it's basically rolling the current debt into the new debt.
Yeah, but how do you refinance zero? If he's got no mortgage on it, what are you refinancing?
If there's debt, if he's got other debt that he's rolling in. In that case, it was specifically a strategy we used because he had his eye on a couple properties, and he needed to buy these properties in cash. And he also needed to buy these properties with enough money available to do some renovations, right? Mm-hmm. So he knew the amount. He had his dollar figures. He had everything lined up. And we went and took that money out of his property. And he already had the budget ready, where he turned around and immediately was able to write a check from the equity of his home that he had released to buy each one of these properties. And now he owns 4 properties. Before he owned 1 property. That's what we're talking about. That's just one idea. But I want to circle back to debt consolidation, because that's where I want to focus, because that's the most life-changing for anybody, is debt consolidation. And like I said, most mortgage programs that allow this cash-out refinance, you're going to be limited to around 80% of your home value if you have a single-family home. If you have a multifamily home, you're going to be around 70, maybe 75%. But if you're a veteran, veterans have preferential treatment. And actually, even as early as, a couple years ago, veterans were able to borrow all of the equity out of their home, 100%. No other loan program allowed that. They did change the rules a little over a year ago, and now veterans can borrow 90% of the equity. That's still a lot more, though, better than a civilian, better than a normal person. So veterans do get a good situation when it comes to this cash out refinancing. And again, a lot don't even know this exists and is available, and they're sitting there wondering what to do with their finances. But if they sat down with a mortgage advisor or just looked a different approach to their finances, they would see this is probably, and in many cases, the best, the easiest, the simplest way to get that money that you need to do whatever you need to do.
So listening to you, it's suffice to say that the interest rates in terms of a cash out refinance greatly differs from other types of refinancing.
Cash out refinancing is a riskier loan. When you're buying a house, you're not getting really money back from buying the house. When you're just lowering your rate on your mortgage, you're not there's not really a lot of risk there because we're, lowering your payment or dropping your term. But when it's a cash out refinance, there is an extra layer of risk because you're getting money in hand. You're getting cash in hand. So investors and underwriters look at that as a higher risk. So you're going to pay a higher rate. Now, we're not talking about a substantially higher rate here. We're still talking about very good low interest rates. Right now, as we're talking in early 2021, we're talking about rates in the high 2s to low 3s. If you have excellent credit on a cash out refinance. So maybe 0.25% higher than a no cash out refinance or a home purchase, but still very competitive and a hell of a lot better than you're going to get with a personal loan.
Yeah, that's, I mean, 0.25%, it wouldn't be a deal breaker for somebody who is really that curious or not just curious, but who desires a cash out. However, though, you mentioned something interesting, and that is, well, I guess you kind of alluded to it indirectly about a credit score. What type of credit score? Or maybe it's a credit profile it is required in order to take advantage of this type of program.
Right. So cash out refinancing, again, having a little more risk. You want to have a better credit score to get the best terms.
Right.
So technically, if you have a lot of equity in your home, when I say a lot, I'm talking about if you have at least 30% equity position in your home, you could get a good cash out refinance typically with around a 620 minimum credit score. You don't have to have great credit because we can make up for that with the equity, you see. But if you're trying to do these higher loan to value, higher risk type of loans, we would really want you to have, 680, 700. If you want the best terms, like any loan, you're going to want to have that credit score up in the mid 700s. That would, put you at the top as far as getting the best terms. But that's one of the other big advantages of the cash out refinance versus other methods is you dictate the terms. We can do a 10-year, we can do a 15-year, 20-year loan. When you're doing a personal loan or something of that nature, they're going to give you like a 3-year and a 5-year. That's it. There's no customization. It's not really going to fit into your financial plan. You have to fit in their box. There's a lot more personalization and the ability for us to really look at your goals and custom tailor a cash out refi for you and your goals. I have a lot of people that do this around their retirement. So they'll say, well, I want to retire in 10 or 15 years, and we'll do a mortgage around that timeline to make sure their home is paid off in the timeline that they're going to retire. Who doesn't want to pay their home off by the time they stop working?
Right. You had mentioned something about a little while ago about consolidating your debt into your mortgage.
Yes.
Why would somebody want to do that? What are the advantages of consolidating your debt into your mortgage?
There's a lot of advantages.
Wouldn't somebody just wiped out their credit cards? It's got a zero balance. Doesn't that get more tempting then to rack up their credit card bills?
It does.
And then they've got now two. They've got an inflated mortgage, and then compounded by a new inflated credit card bill.
That's the big mistake that people make when they do a cash out refinance. And I do want to elaborate on that.
Please do.
Before we get to that, I want to answer your question. Why would someone want to do a cash out refinance, consolidate their debt specifically into their mortgage?
Yeah.
Because they might have been told that's a bad idea. That doesn't make sense. Why would you take unsecured debt and turn it into secured debt? Well, number one, like we've been saying, lower interest.
Rate.
That's it. Period. Would you rather pay 10% or 5%? Would you rather pay 5% or 3%? It's really that simple on the surface. Also, because you have that customization I was just talking about, you can take that credit card debt, for example, that's got a specific minimum payment, and we can stretch that out over a long period of time, which lowers your payment, which increases your cash flow. So that's why you would want to do it. As far as the big mistake that people make that I was just touching on is, if people consolidate their debt into their mortgage and they just pay the minimum payment every single month, that's the trap. That's what the banks want you to do. That's exactly where they want you to be. Because then they've got you, like you said, two places. They're getting you on the mortgage, and now you've got new credit card debt. So the key, the big paradigm shift that people need to have when they do a cash out refinance, and what I've been teaching my clients for almost 2 decades, is to look at their budget before the cash out refinance. If you were paying $2,000 a month between your mortgage and all your debt before you refinance, what if you kept paying $2,000 a month after the refinance? And what we find is most people can pay their mortgage off in half to a third the time. That's how you capitalize on refinancing and debt consolidation to your benefit and not the bank's. We can take the money that was going to interest on personal loans, on credit cards, on medical bills, on all these other debts, and now we can put all that money towards your principal of your property. When we start approaching it like that, now it's a financial plan. Now it's not just a lifeline. It's part of your overall goals, and it's going to fit into what you want to do. And again, nobody's teaching this. The banks don't want you to know about it. You need a mortgage advisor to show you these strategies.
All right, so let's go into that. But I've got other questions as well. But let's talk about the mortgage advisor. Your role in this. Somebody comes to you about this. I mean, number one, how do you get paid on this? And I guess the average person would say, oh, this is just another layer here. I've got to pay a middleman or another person. But then you got to interject and say, but this person's going to advise you in how to save money. Is it kind of like where is it worth it to pay me $20 to give you advice that's going to save you $100?
That's the exact example. And I think first of all, nobody's paying me if you come to me as an advisor and you want to work with me and be a client, you are not writing me a check for my services. The consultation is 100% free. I review your credit reports. I look at your debt to income, all the different things. We talk about your financial plan. There is absolutely no cost. Where I make my money is getting you the loan. Okay. And I'm not a mortgage broker. I'm a banker. So the company that I work for, we lend our money directly, and we do make money by, selling servicing. And obviously there's interest involved, even if it's a small amount. So there is money being made. That's how I get paid, but it's not something that you're going to write a check to me for. And if I can't help you, or we can't get it approved, or you decide it doesn't work, no cost, no obligation at all.
How often does somebody consult with you? How many meetings in a year? Once, twice, three times?
So clients that have been with me a while, we do normally an annual review every year. When somebody starts out with me, we do a 6-month review. So assuming that you get a mortgage today, we're going to talk in 6 months to make sure it's all working, make sure everything's good that we set up, because things change. Then we're going to do an annual review on your 1-year anniversary. So if we did a mortgage now in February, we're going to do an annual review in February of next year, and then February the following year. And what I find is usually the 6-month review, a lot doesn't change, but at that 1-year review, that's where people start changing goals. That's where they start thinking big, because they've been saving all this money, and now it's like, okay, how do I build wealth? I've got all this money now in my savings account I didn't have before. Or I built all this equity because I'm paying all this extra money on my mortgage that was going to my credit cards. So now I've got all this extra equity in my house. What can I do with that? People's minds start racing and start shifting to see the opportunity that they have that before it wasn't even an option. And the other thing is the credit score. When you do a debt consolidation refinance, by definition, your credit score is going to go through the roof almost every single time, because other strategies to get rid of your debt, like debt settlement, debt negotiation, bankruptcy, those ruin your credit. A debt consolidation refinance, whether it's a mortgage or a personal loan, I'll give them, kudos to say at least that protects your credit. At least that doesn't harm your credit, because we're paying your debt off in full. Every single dollar that's owed is getting paid to a zero balance. When you do one of those other strategies, again, debt settlement, debt negotiation, bankruptcy, those hurt your credit because they're not paying the creditors in full.
You're saying to a zero balance. I was informed one time that you should at least you shouldn't have a zero balance. You should at least maintain some balance. Even if it's a credit card, don't pay your credit card down to zero every month.
And I definitely use that strategy with clients that are trying to build their credit. You want to keep a very small balance. So if we pay it to zero, then go to the gas station and get a tank of gas, okay? Or get a pack of gum to keep it active. I agree. But what you find is when you have a lot of debt, specifically when you have a high debt utilization ratio, meaning that you're using a large percentage of your credit limit, the credit score companies and the credit score algorithms, they just hurt you so bad with that. You may have never missed a payment, but when you start getting up to 50%, 70% of your credit card utilized, so on a $10,000 credit line, 70% is $7,000 owed. So you're thinking, hey, I got $3,000 available. No. Once you start using higher than even 30 to 40% of that ratio, they start saying, hey, we got to look at this guy. He might be in financial trouble. We really need to step back and look at what they're doing, and then they start hurting your credit scores.
Folks, you're listening to Mortgage Matters with Rob Weinberg. I'm Gary Byron. All right, so then what is the big mistake that people make when doing a debt consolidation refinance?
It's making the minimum payment. They simply take that, credit card debt, they put it into their mortgage, and they say, wow, I'm saving $1,000 a month. And now they take that 30-year mortgage or 20-year mortgage, and they pay the absolute minimum every month, and then they start racking up the credit cards like you alluded to. The key, as I mentioned a minute ago, is to look at the budget before the cash out refinance. What were you doing before you consolidated your debt? And then do the same or something similar after. Because if you were paying $2,000 a month before, we know it's in your budget. You might have been struggling, but you were doing it. If we're saving, let's say we take $2,000 a month down to $1,000 a month. You look at that as, well, we're saving $1,000. But what if we took half of that, $500, and we started plowing that back into the principal? Now you can pay off a 30-year mortgage in 17, 18 years without actually changing your budget because, again, you were already committed to paying that to the credit card companies. We're just reconfiguring how you're paying your debt and doing it to your advantage instead of the banks.
All right, so give me some real-world examples and case studies of cash-out refinancing scenarios.
I definitely have some good ones for you. And before I get to the first one, I want to preface that by saying that for a lot of people that are looking to consolidate their debt into their mortgage, like we were just saying, their credit might be on the lower side. It may not be 740 plus, but don't get discouraged by that. Because as we mentioned, you can have your credit score going through the roof very quickly as a result of this debt consolidation refinancing strategy. What that creates is something what I call a progressive refinance or a two-step refinance strategy. Step one, let's go ahead and consolidate your debt and get your credit score up. Whatever type of loan we can get you, we get what we get. You can't be picky. Your credit's not great. Once we do that, you'll find normally within 60 to 90 days after those credit cards or other debts get paid off, your credit is going to shoot up. I've seen some clients, it goes up 20, 30 points. I've seen other clients go up close to 100 points in literally 60 to 90 days after the debts get paid off. And the reason it takes that long,
I don't think it's that long at all.
Some people think I pay off a credit card on a Monday, it'll show on a Tuesday. That's not the way it works.
That's not realistic, right?
It does take the credit bureaus and your creditor anywhere from, it could be 30 days, but I coach all my clients, be ready for 60 to 90 days. All of a sudden, you start seeing that credit score going up. You start getting offers in the mail. Don't be tempted. But the second step of the progressive refinance or two-step refinance is once we've got your credit in that position, I usually, at that 6-month check-in, we look at, hey, we had you at like a 4.5% rate because you did the cash out refi, you had a lower credit score. Now your credit's 740. Okay, now your home value, and you've been building equity over the last 6 months. Now let's do a regular refinance. Let's not pull out any equity. Let's just do a regular refi. Let's drop that rate from 4.5 to 3.5 or 3.5 to 2.5. Now you can really take advantage. And people talk about, well, I can't refinance that much or that's too soon. Is there benefit? That's the question you should be asking. And going back to what you said earlier about what's it going to cost, well, especially in the case of a debt consolidation, you need to be looking at what is it costing you right now to do nothing? How much are you paying in interest on your credit cards, on your personal loans, on your student loans, on your medical bills? Let's compare that to how much you're going to pay by refinancing, even including any closing costs and fees. And almost every single time, without exception, it's going to save you tens of thousands or even hundreds of thousands of dollars, even after considering the costs and fees. Okay?
Wow. There are people who don't even know I don't even know my credit score anymore. Because I guess you can call Experian and Equifax. There's so many different sources. I don't know which one to believe. They could be different. I stopped. I don't even know what my credit score is right now. It's sad to admit, but I'm going to.
And
anyhow.
That's one of the reasons a lot of people come to me with that. And that's one of the reasons why it's so important to have some sort of mortgage advisor, credit coach, somebody that's going to lead you to what your credit score is. Because here's the problem. A lot of people are getting their credit scores from Credit Karma, Credit Sesame, Discover Card, Capital One.
And that's not accurate.
That's not the same credit score that a mortgage company is going to use. That's it. It's not. So going back to your question on the example, I want to run through real quick. I want to tell you about a client of mine that had lower credit. They had no mortgage, but they had a property that they had owned for a couple years. They inherited. They had over $80,000 in credit card debt. We were able to take the $80,000, consolidate it into a new mortgage, and they saved $1,400 a month. That was the first loan we did. But again, they had low credit. What we did then was a year after that, they had better credit, but they still had some debt. They had still racked up some more debt, okay? We went again. We did another refinance for them this time. We consolidated the next $30,000 in credit card debt, and we dropped their rate a little bit from what they were paying before. That refinance, they saved $450 a month. Okay, so if you're adding that up, that's almost $2,000 a month they saved in the course of 24 months. And the cherry on top of this was just in the last 60 days, this client came back to me. Now their credit is in a position where they're in the high 700s. Now we did a third refinance for them. We took them from a 5.7% mortgage rate all the way down to 3.5%. Because they took these steps, and now they're saving another $150 a month, and now they're able to pay their house off early.
From beginning to end, how long did that take, that process?
It was a 36-month
process. No,
process.
but from the time they first met with you with their score of 5-something was terrible to how long was that duration of time? A year?
I mean, when they met with me until they closed on the refinance,
yeah,
it was just a few months. I mean, it was less than 60 days. We were able to get that first refinance.
Okay, and
done.
then you got a second, and you got a third.
Right.
What? Give me the beginning. So
it was in 2019.
Okay.
Okay, in 2019, we did the first refinance. It took about 60 days.
Okay.
Their credit, it wasn't in the 500s. It was in the low 600s.
Okay.
Okay.
All right. I got it.
But the reason it was low was because they had all this debt. So we did that refi. 1 year later, on their anniversary of that, we did the second refi, and then we did the final one, and that's that.
That's the answer I was trying to get to. All right, so I know there's people who are very, very, very interested in meeting with you, Rob Weinberg, and I got to say, even I'm piquing my interest. I tell you, start here. Start with the website. I always tell people, if you've got questions right now generated from this show, write them down. Get a legal pad out, scratch out all these questions that you have. But before you make the phone call, check out the website. It'll number one, it may answer some things for you. But where I'm getting at is it'll probably spark other questions to ask that you want to add to your list. So that way you can ask Rob all of these questions at once. Go to RobGW. That's RobGW.com. Once again, RobGW.com. And if you've got a question that you'd like to ask him, please email him directly from the website. You can just click on the email button and you can ask him a personal question directly. Then you make the phone call. This might be one of the most important phone calls that you make in all of 2021. I'm going to give you the phone number, but I'm going to give you an extra couple of seconds here because I want you to get a piece of paper right now, get a pen or a pencil. All right, I can only stall for so long. Ready? You getting it? Write this phone number down, 860-413-3938. It's that easy. I'm going to say it again, though, 860-413-3938. This will be one of the most important phone calls that you make in all of 2021. When it matters to your wallet and your financial future, it behooves you to make this phone call and meet with Rob Weinberg. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters. Until next Saturday, have a good one, everybody. So long.